Have you ever wondered what actually separates billionaire investors from the average person who consistently loses money in the stock market? Warren Buffett famously noted that if you have an IQ of 150, you should give 30 of those points away to someone else. Intelligence simply does not dictate your success here. The game of wealth creation comes down to a strict 80-20 split. 20% is the cold mathematical mechanics of finance. The other 80% is entirely human psychology. If you want to stop working for your money and force your money to work for you, you have to understand both the simple math of the market and the deep evolutionary flaws of your own brain. We begin with the 20%, the mechanics. The baseline is the time value of money. A dollar in your hand right now is vastly more valuable than a dollar promised to you 10 years from now. If you leave a dollar sitting in cash, inflation quietly erodes its purchasing power every single year. But if you invest it, that cash generates yield, growing into a much larger sum over that same time frame. Compound interest serves as the mathematical engine of the market, taking your initial yield and using it to generate even more yield, year after year. This chart tracking Warren Buffett's net worth shows exactly how this works. Notice the curve stays relatively flat through his 20s and 30s. He didn't even reach billionaire status until age 56, at which point his wealth aggressively curves upward into the tens of billions. While Buffett's selection criteria are legendary, this exponential growth requires decades of uninterrupted holding. His wealth is a product of consistent selection combined with extreme longevity. To capture that growth, you have to navigate the relationship between risk and return. Every financial asset exists on a strict spectrum balancing safety with potential yield. On the conservative end, you have cash and government bonds. These offer a high degree of security, but the trade-off is extremely low growth. On the aggressive end, you find venture capital and crypto. These assets offer massive upside, sometimes thousands of % in return, but they carry a high probability of going to zero. This diagram illustrates the barbell strategy. Place a heavy allocation of capital into safe assets for protection, and a smaller allocation into aggressive assets for growth. Because of this structure, even if your crypto allocation drops to zero, your core wealth remains intact. With risk carefully structured and the math solved, investing looks incredibly straightforward on paper. But then the human element takes over. This brings us to the 80% of the equation, your mind. If the formulas for wealth are public and simple, why do so many people end up bankrupt? Our brains are hardwired by evolutionary biology to prioritize acute panic over long-term logic. For early humans, assuming the worst was a required survival mechanism. If a bush rustled in the jungle, our ancient ancestors didn't wait to analyze the data, they ran. Fleeing at the first sign of a hidden tiger kept them alive, but running at the first sign of a dropping stock market destroys portfolios. These instincts constantly sabotage modern investors. The trap usually starts with euphoria. A fear of missing out overrides any rational valuation, causing people to buy aggressively at the absolute peak of a market rally. Then, when the market inevitably dips, loss aversion kicks in. Psychologically, losing a dollar causes twice as much mental pain as earning a dollar causes pleasure. Desperate to stop the pain, investors fall victim to confirmation bias. They scour forums and news feeds, actively searching for pessimistic opinions that validate their emotional need to escape. Our biological heart air was expertly tuned for surviving a hostile jungle, making it disastrous for surviving capital markets. The late Charlie Munger extensively studied how these specific mental flaws ruin investors. He coined the term Lollapalooza effect to describe the moment when multiple cognitive biases trigger simultaneously, completely overriding a person's rational thought. During a market crash, you see this happen on a massive scale. Loss aversion, confirmation bias, and herd mentality all collide, resulting in contagious panic. This leads to the final stage of the market cycle, capitulation. Out of pure frustration and anger, the investor sells their assets at the absolute lowest price, locking in a permanent financial loss. The market creates the environment for potential loss, but the individual investor's decision to exit during a panic is what converts a temporary dip into a permanent loss. Because you cannot reprogram millions of years of human evolution, You cannot rely on sheer willpower or intelligence to carry you through a crash. The only reliable solution is to build a cold, automated system that acts as a psychological cage for your instincts. The first rule of this system is to pay yourself first. The moment your paycheck clears, you systematically carve out your investment capital before paying a single bill or expense. Second, strictly enforce your barbell allocation. You execute your specific split between safe and aggressive assets relentlessly, ignoring whether the market is peaking or plummeting. Finally, commit to an unbreakable 30-year time horizon. When you extend your timeline by decades, you realize that daily market fluctuations and short-term panics are just irrelevant noise. Mastering your own temperament allows the math of the market to work in your favor over the long term. This is how financial freedom is ultimately built.